When we think of accounting, our minds probably jump to, well, boring spreadsheets and endless numbers, right? But what if I told you its real purpose isn't math at all, but language? It's the universal language of business, a system built to create clarity and trust across the entire economy. So let's break down how it works.
Just think about it for a second. How can an investor sitting in Mumbai confidently compare a cool new tech startup in Bangalore with a massive manufacturing firm in Chennai? And even more important, how can they trust that when one company talks about profit, it means the exact same thing as when another one does? This is the huge problem that accounting was created to solve.
I mean, without a common framework, financial reports would just be total chaos. A wild mix of personal opinions and, let's be honest, some pretty creative calculations. It would be absolutely impossible to trust the information, let alone compare companies. For our whole economy to work, we need a shared rule book.
And that rule book actually has a name. It's called GAAP, and it's what brings order to all that financial chaos. You can pretty much think of it as the grammar and the vocabulary for the language of business.
So what exactly is GAAP? Well, it stands for Generally Accepted Accounting Principles. Basically, it's the standard set of rules and guidelines that companies are expected to follow when they record and report their finances. The main goal is really simple: uniformity, just to make sure everyone is speaking the same language.
But GAAP isn't some ancient text carved in stone that never changes. Not at all. It's more like a living thing. It has evolved over many, many years, based on real-world experience, and it's constantly adapting to shifts in the economy and the law. This flexibility is exactly what keeps it so useful and relevant.
Okay, so GAAP is huge. But don't worry, you don't need to know every single rule to get the logic. To really understand how it all works, we're going to focus on just 3 fundamental concepts. Think of them as the pillars that hold up the entire structure of modern accounting.
All right, our first pillar. And honestly, this might be the single most important idea in all of accounting. It's called the business entity concept. This is where everything begins. The core idea is actually pretty simple. For accounting purposes, the business is treated as a person that's completely separate from its owner. So even if you're the sole owner of a company, in the eyes of an accountant, you and your business are 2 different entities.
And here's where it gets really powerful. When an owner puts money into their business, the business now owes that money back to the owner. The owner's investment is actually recorded as a liability, a debt on the business's books. This is what creates that clean separation between an owner's personal finances and the business's finances.
Okay, let's move on to our second pillar, which is the money measurement concept. This rule is all about deciding what actually gets to be written down in the accounting books.
And the rule is simple and very strict. If you can't put a monetary value on it, you can't record it. Accounting only deals with things that can be measured in a currency, whether it's rupees, dollars, or anything else.
Now this is where it gets fascinating. Think about the things that make a company truly valuable. The incredible morale of its employees, a fantastic brand reputation that everybody loves. These things are priceless, right? Well, that's exactly the point. Because you can't put a reliable monetary value on them, none of these super valuable assets actually appear on the financial statements. It's a great reminder that accounting measures financial value, not all value.
Our third and final pillar is the engine that makes this whole system run. It's called the dual aspect concept, and it is the absolute foundation of all modern bookkeeping. This principle says that every single business transaction has 2 effects, a dual effect. You don't just record what you got, you also have to record how you got it. This simple but really profound idea is the heart of the entire double entry system. Now, this twofold effect isn't just a theory. It's captured in one elegant, perfectly balanced formula, the fundamental accounting equation.
Assets equals liabilities plus capital. Every single transaction, no matter how complicated, has to keep this equation in balance. It's the ultimate check and balance of the entire accounting system.
So let's just quickly break this down. Assets are all the resources the business owns. Liabilities and capital represent who has a claim on those assets. Liabilities are the claims from outsiders like banks or suppliers, and capital, which is also called owner's equity, is the claim of the owners. So, you see, everything the business owns is claimed by either an outsider or an owner. It always balances.
So, we've looked at the 3 core pillars of accounting. But let's just zoom out for a second. Why does having this strict, rule-based system actually matter in the real world?
Well, without these shared rules, we'd have chaos and mistrust, which makes smart investment pretty much impossible. But with a system like GAAP, we get order and reliability. This lets us properly compare a company's performance over time and also compare it against its competitors, which is the whole foundation of making informed decisions.
Ultimately, these aren't just rules for bookkeepers. They are the principles that create the trust and transparency that our entire global economic system relies on. They are the bedrock of investment, credit, and all of commerce.
And that brings us to a final thought. We've seen that these principles can evolve. So in today's economy, which is so driven by intangible things like data, algorithms, and online communities, how will the money measurement concept adapt? How might we account for these new forms of value in the future? Well, that's the next chapter for the language of business.